is Wednesday, November 18th, 2020. Today in this episode, I will talk about the company Fiverr and share a couple of thoughts with you. Fiverr is an Israeli company. Through its global marketplace, it connects freelancers and businesses for digital services. Like other gig economy companies, the company makes money by taking a cut from transactions done on its platform. Fiverr was founded in 2010 and it went public in June 2019. In the most recent quarter, it reported $52 million in sales, which is up 88% from the quarter a year ago. The company now has freelancers providing digital services in more than 400 categories across 8 verticals, including graphic design, digital marketing, programming, video, and animation. According to the company, in the most recent quarter, active buyers have grown to 3.1 million people. They bought digital services from sellers across more than 160 countries. Fiverr's growth strategy is to bring new buyers onto the platform while retain and expand their spending over time. The company has recently launched Fiverr Business to target businesses with deeper pockets. They have also launched an array of tools such as the Fiverr Learn, Logo Maker, Promoted Gigs to help sellers better adapt to their platform. The company has no direct sales team. They try to increase brand awareness via marketing campaigns and through word of mouth. FVRR is one of the top performing stock in 2020. It has grown more than 550% to date. In the past 52 weeks, it has recorded a low of $19.32 and a high of $191. After the recent rally, the company now has a market cap just north of $6 million. Fiverr have consistently delivered exceptional results in its brief history since IPO. The company reported its Q3 result on October 28, 2020. Although sequential revenue growth has slowed down from 38% in Q2 to 11% in Q3, revenue was still up 88% from a year ago. Adjusted EBITDA margin has improved consistently since IPO. The company first reached EBITDA profitability in Q2 2020. The company has been able to attract more and more buyers to its platform while growing buyer spending on the platform. In Q3, active buyers increased roughly 300,000 from a quarter ago, and the spend per buyer grew $11 to $195. Of ownership, insiders hold more than half of the firm, while institutional investors hold roughly 1/3 of the company. Decision-making is largely concentrated in a small number of individuals. According to the company filing, Colbert Jonathan, a partner and a senior advisor at Viola Growth, holds around 12% of the equity stake, while Micha Kaufman, CEO and co-founder, owns 6% of the company. No other members in the senior management team hold more than 1% of the outstanding share as of December 31st, 2019. Micha Kaufman is the only person in the management team that is on the board. The other 6 board members are all independent directors. In May, Fiverr raised $120 million in an equity offering at $6 per share. In October, it announced a plan to raise $400 million 0% convertible senior notes due in 2025. The conversion price is $213.57, representing a premium of around 25% over Fiverr's current share price. The proceeds will provide a safety cushion to combat the ongoing COVID uncertainty. Although this offering is not attractive from a yield perspective, it is still fully subscribed by private investors. As of September 30th, 2020, Fiverr has very little long-term or short-term debt. Now, here comes the important question. After a strong year in 2020, can the stock go higher in 2021? In my opinion, I think the upside in the next 12 months is very limited. Why? First, after Pfizer said that their vaccine candidate has been 90% effective in preventing COVID-19 infections in ongoing phase 3 trials, market's repositioning to value stock has been triggered. It is an event that is destined to happen. The value share growth to value ratio currently sits at 1.3. The last time when it was this extreme was during the dot-com bubble. Also, if you take a look at the relative performance, value this year has outperformed growth stocks by more than 35%. The last time value had underperformed growth by this much was also during the dot-com bubble. What happened next was that growth stock underperformed value each year in the next 7 years. Although history seldomly repeats itself, it often rhymes. I think investors will likely to see value stocks outperform growth stocks in the coming years following the crisis. With that being said, I do expect the moving away from growth plays will be gradual and a back and forth battle with a lot of volatility. Because on the one hand, investors are expecting value stocks to recover on the back of a slew of positive vaccine news. On the other hand, reality is that we're seeing a number of cases continue to take up in the US and in Europe. And you have these growth names reporting record-breaking numbers every day. Second reason is to do with valuation. Due to COVID-19, investors in 2020 had to reassess the company's fundamentals based on this new reality. Fiverr is one of the companies that have seen rapid multiple expansion. For instance, on February 20th, 2020, the company traded at only 6.6 times price to next 12 months revenue. Keep in mind, this is before the COVID crash. Fast forward 9 months, the company's multiple expanded more than 300%. It is now trading at around 26 times next 12 months revenue. To put things into perspective, Fiverr's close competitor Upwork trades at less than 10 times price to next 12 months sales. In my opinion, at this level, Fiverr is clearly overvalued. In 2021, Fiverr is expected to grow at 37%. I'm valuing the company at 17 times price to 2021 revenue. The implied share price is $124, which is 30% lower than the current price. Adding to the concern is that boost from COVID-19 may gradually fade away. While it can be argued that work-from-home trend is here to stay in the post-COVID era, growth might slow down as uncertainty subsides and companies turn to full-time employees. Despite everything that has been said, I'd like to point out a few positives. First, the company has a strong management team that has consistently delivered exceptional results. Second, although the talent acquisition industry is fragmented, the opportunity is enormous. Third, the company's higher than average take rate shows superior platform strengths. Last but not least, people's perception on freelancing is a long-term positive for the industry. To sum things up, Fiverr is an online freelancing market space with a lot of potential. However, I think the risk-reward is skewed towards the downside in the near term. The stock could potentially drop more than 30% as the market reassesses the COVID winners in 2020. Safe investing to all. Please hit the subscribe button for more stock analysis video. I'll see you next time. Bye bye.